Guys, June 14th, 2019, Friday. Finally, it's Friday. However, this Friday could be one of these Fridays where we actually have a probability of a move 5. And you guys should know by now, move 5 means trade small or don't trade at all. However, I will give you just a few insights about a couple of sectors that could be beneficial to focus on specifically today, that could help you avoid all the craziness associated with that move 5. With that said, guys, I'm going to have to talk a little bit fast today because there's really a lot of stuff going on. So, despite all the negative headlines, market wants to move higher. As my message said, I was really calculating the move 6 later in the day, and we got exactly the opposite of that. So, sometimes when that happens, guys, sometimes when the calculations go exactly the opposite direction, that actually gives you a clue that, hold on, despite of all these things, despite of all the things that are pointed out to the next move lower, maybe we're just not 100% ready to make that move lower yet, which oftentimes could push a lot of traders out of their positions on the put side because the market is going to make that one final move and push higher before it's actually going to make a bigger drop. So with that said, we're going to be trading extra cautious today because I think there will be a retest of these 28.98, 29.05 by 11 p.m. Now, clearly, if we get a break above 28.11, then we've got to cut the puts. We've got to get out because what was explained in the video a few days ago, we could actually visit this 29.50 level. And again, market could just keep drawing this moves 11. We did notice a slight shift in the pattern from move 11 to a W or a double bottom, which we're going to talk about that in a sec. So if this shift in behavior continues today, guys, we've got to be extra cautious. Gold divergence resurfaces again pre-market. It's actually hitting a 14-month high at 1356 was early actually. Last time I looked was above 1360. So very cool stuff developing on gold, but maybe not so fast. So we're going to actually glance of what is propelling the gold high and what could actually take place on Wednesday with gold. Now, clearly, AVGO tanks the entire semiconductor sector, including Apple. However, what we're noticing pre-market so far this morning is they're buying the dip, not in AVGO. If you look some of the immediate responses to the AVGO, and basically for those of you that don't know all the details are not that important. The most important crucial part of AVGO report was such that the CEO basically says, hell with it, we're slashing all the forecasts because of the China-US trade war. He actually said that. So with that, naturally you'd expect Apple to sell off. The immediate response to Apple was just a couple of dollars lower. Actually, Apple pre-market surrendered $4 from yesterday. And it looks like they're trying to come in and buy the dip in Apple around the 190 level and moving it back so far, at the time I'm recording this, to about 190, 180. So semis are down and they're likely to stay down. So focus on the sectors like the semiconductor sector, the technology sector. They're all going to get hit hard. And we don't want to be buying the dip in that sector. What we do want to focus is shorting the bounces. And I'll walk you through a specific trade in just a second. And congratulations, guys, to all of you that did take the AVGO trade. I specifically put in the chat, hey, I don't do this often, but the chart was just looking so juicy and good, I just couldn't say no. So I had to do it. It worked out well, but I still think there's money to be made on AVGO for those of you that missed it. So again, watching this critical level today, we are continue building and buying puts, thinking that the 28.11 breakout has a lower probability than revisit of these levels and moving lower again. Now, with that said, we'll walk through the AVGO. Some stocks we're keeping attention on, and if you get some messages intraday, just keep an eye. Look at these charts. Study these charts, guys. Chart of Blue, which is a biotech company, BGNE, REGN, all of these guys are in the same category if you're working off your winning watch list. Guys, if you haven't taken the Trade Like a Rockstar course, really pays because some of these trades, they're really great trades if you know how to compare them, if you know what to look for. So take action on that. And guys, I am going to answer some questions I saw in the chat room about the black candles and so on, but the reality is this. Guys, you need to understand this chart patterns. You need to understand the divergences and you've got to take action. You got to take the course so you can make the best out of this daily information. Because the reality is this: we got guys that are making 100 grand a month. We got guys that are losing 1,500. So look, what's the difference? We're all working with the same information. But the difference is this: it's the execution, number one, and number two is the ability, to scale in and out of the positions properly. And being able, the most crucial factor is being able to take action on the information. So if you're looking at some trades and you're not taking action, I mean, clearly AVGO is just a quick and easy example, right? So typically I don't take a whole lot of time to send you a message about something if I don't think it's important. And so just making some of these observations could really make a huge difference in the outcome. So for those of you that are ready to learn, let's dive in and check this out. So gold hits 14-month high pre-market, 1362.2, retraces back a little bit. But the significance of this is everybody's waiting for gold to break out about this 1350 level in a meaningful way. So this is not like a real breakout. It's just everybody expects the Fed to be dovish. And if we take a look, though, at the chart on the daily chart of gold, we're going to see it's been to this level many times. So last time it got to this level, it went lower. This time it got there, it went lower. So chances are, once it gets there, and it could easily move maybe another 10, 12 points higher from here. But when it does, chances are it will reverse. Because the multi-month chart on gold actually points to a fact that every time it visited that level too many times. And as everybody's expecting Fed to be dovish, my personal opinion is different. Everybody expects, further rate cuts. Everybody discounts the fact, in my view, that Fed is going to come out and say, hell no, we're not lowering interest rates. Actually, we may think about it in September. We may consider doing it in December, but we're certainly not doing it right now. And if that's the case, then gold is going to have a very difficult time to break above this level. So gold actually on Wednesday could drop. So now, clearly, if that is not the case, and Fed indeed proves to be extremely dovish, then gold will break above that level, and that's when we want to come in and buy it. So it's too early. For those of you who've been getting a lot of questions, like, do I need to jump in this gold trade now? We will cover the gold trade maybe on Wednesday or Thursday of next week, and there's specific charts and instruments how we can take advantage of the gold potentially moving higher. Now, before we get there, we want to make sure that the breakout in gold is indeed very meaningful. And clearly, some of the things that will happen if gold moves higher, typically dollar will drop. So there's a few other trades that could be put together, though, for those of you that are interested. Now, focus on these trading tunnel levels. We've discussed those. And the main observation for today is that this trading range likely to continue, tighter trading range likely to continue until the Wednesday Federal Reserve announcement. So instead of looking at these grander range, all we're expecting is to play in these levels right here, 29.05 to 28.69 basically. And we just discussed what to do if we break above 29.05, 29.11 area. So if we break above this high that we established just a couple of days ago, it really makes sense to cut the put positions because we could be going to 29.50, and that would be a much better level of entry instead of tolerating all the pain of that 40-point move high, potential move high. Now, overall, the highest probability remains in such as we're going to keep trading within this tunnel. So we're going to continue using the strategies. We're getting closer to this 29.05. We're going to short. Now, we're not going to wait for a dramatic drop because I don't think dramatic drop is going to come until maybe Thursday or Friday next week. So what we could see is, maybe a pullback to 28.90 should be the first target to start selling some of those puts and collecting gains, and further drop to possibly 28.70. So we're not calculating any huge drop between now and Wednesday. We basically think that there's a 70-80% probability of continuing to trade in this tunnel. So use this as a tighter trading range to target your entries and collect gains. So mid-level of the tunnel will be this 28.89, and this is actually exactly where we're trading pre-market at the time I'm recording this and taking this snapshot. So keep this tighter trading range in mind, guys. It should make your job easier, and the tighter the trading range, the better off you're going to be trading options in the money or near the money. Again, in this type of a trading range, you do not want to be buying puts or calls out of the money. It just doesn't work. It's about a 90% probability of a loss. So in the money or near the money. So yesterday, we had some questions in the chat room. And guys, I know some of you, like, it seems like we're not taking a lot of trades. There's just not a whole lot of stuff going on. Some of you are naturally getting bored. But I don't believe, guys, in, being bored in any kind of day in the market. Certainly, if you're trying to get better, and I know a lot of you, that's why you sign up for this. I know there's a lot of you sign up for the service because, hey, you just want to see what I'm trading. You just want to catch some trades. And, that's probably not the most effective and efficient way to work this program. Ideally, you want to take the courses so you understand the information that's being discussed so you can make more sense. And more importantly, you don't want to be subscribed to the service forever, right? You want to be able to ultimately trade on your own and find these trades and being able to reason and explain them and identify them. So the question surfaced in the chat room yesterday, what are the black candles? There was also some comments about how the market was boring. So comment number one, guys, look, the market shouldn't be boring. You should be looking at 30, 40 charts each day, really looking for a lot of trades. So for me, I got 100 things going on at any given time, so I would be happy to look at 200 charts every day, but certainly find time to look at 30, 40 charts daily. That is a habit of mine. And so if you're not currently doing that, on those times of the day where the market could appear to be slow and you're trading actively and you consider yourself a full-time trader, or you're just almost there being full-time trader, that's what you should be doing. You should be looking at charts. And then you shouldn't be that bored because you're really trying to identify some correlations. And if you keep doing that, you will identify some really cool trades. So with that said, black candles, study the charts, divergences, and pattern recognition course to really fully understand them. I'm just going to give a quick explanation. Okay, so in yesterday's video, we basically said there's going to be some profit taking in Lulu and RH, and there is a great probability that these black candles were going to be created. So I want you to actually pull up the chart just like this if you want to understand this better on stockcharts.com on the daily time frame. This is what you're going to see. This is the black candle. There's two other important observations here. These black candles, they are being created when stock price action is moving higher. Okay? So remember that. On the day when the black candle is created, when you're going to look at your trading screen, the price is going to be in the green. It's going to look to you, without knowing all this stuff, it's going to look to you like they're buying the stock. So the last thing you're going to want to do is to buy puts. Naturally, everything inside of you is going to scream, I want to buy calls. Man, look at this. This thing is up $12. What if it goes, another $12 higher? Damn, I'd make a killing on these calls. So to identify this is what you really need to pay attention. How does the stock open? When does the sell-off? Does it take the double top like on the 1 day, 1 minute chart? But to understand these black candle, what it really means, as the stock price actually moving higher, institutional investors are coming in and they're taking profits. Look at this increased volume. This is very deceiving. Guys, I'm giving you some crazy secrets here, okay? So it looks like this is a great volume bar. However, it should really be portrayed as a red volume bar because they are not buying. See, this bar right here technically tells you that they're buying the stock, but they're not buying it. They're actually selling it. And the reason you would know that institutions are actually selling the hell out of this thing is because look at what accumulation and distribution is telling you. So not only they're distributing the stock, they're not accumulating it, they're getting out of it, but they're also doing it on much stronger volume than the typical volume, okay? So basically institutions are using this great earnings report as a way to cash out of their positions. On day of the earning reports, your volume is going to be stronger. They're taking advantage of this volume to liquidate some heavy-sized positions, some strong positions. Same thing with RH, right? Here's your black candle. Now, the crazy part about this candle, remember, talked in yesterday's video for a while about these levels, 120, 125, and why it was important and so on. So review that if you're really trying to understand this better. But same thing, look, huge volume portrayed by a gray bar, which technically tells you they are buying, but they're not buying. Why? Because look at the accumulation distribution. It's dropping like a rock. So they're actually selling it. They're selling stock against this level. Now, moving forward to AVGO. When I send out the message, say, hey, I don't do this very often, but I'm doing this because the chart looks good. Look. See, in black candle, guys, got to pay attention to the small things that do make a huge difference at times. So you shouldn't be bored. You should be looking down the charts. Is the bottom line. But in this case, these black candles appeared after the earnings announcement. In case of the AVGO and my decision to actually get in the trade before the earnings announcement and keep it through the earnings announcement, because this candle was created in the expectation of a poor earnings report. So sometimes if you can catch these black candles a day or two before the earnings report, that really tells you, hold on, investors already know what the hell is going on, and they may not know, but the expectations clearly point to the fact that they're going to sell. Especially, it's an identical situation to what we just seen right here on the RH. Check this out. So RH, what's the identical situation, you may ask? Well, it's against the level, the 120, 125 level after the gap down. What's the identical situation here on AVGO? It's against this blue line level with multiple gap downs. We've covered that in some prior videos over the last month or two. So here's your gap down. Here's another gap down. It's against that level, and that's where they're selling it. What else do you guys see? The hook. Can you see the hook? The blue line. Here's your orange line. Here's your blue line. The blue line is starting to look like it wants to get closer and intersect this orange line at some point, which would be a death cross formation. Not mentioning a bunch of other stuff like, right, you got a hand and shoulder and accumulation distribution here. When the stock rallies in the last 10 days, basically sharply higher, nobody's actually buying it. That's a divergence, right? The price action is higher, but nobody's buying the damn thing. So it really tells you a lot. So when you see a chart like that, guys, especially if you take a look at some other things like the weekly, and you got all these bearish reversal candles. Okay, and look, here's your level. Remember, a few days ago, I sent a message, hey, start buying this 290 puts on the AVGO. Because it's the level. It's this 290 level. This is where your bearish reversal candle is. Okay, you got your, crossover on the MACD, bearish crossover, and this gap is actually widened between the orange and the black line. Tells you, hey, further drop is in the making. Same confirmation, accumulation, distribution. So with that said, you're like, damn it, I should have been looking at the charts, but I was goofing off. Okay, fine. Just make some conclusions. Make sure you use your time wisely as you trade, and some of these days could appear to be slightly slow. Prepare yourself for success on the days when this information of looking at the charts over and over again, identifying some of these things is going to come handy. So, you got to prepare for success, guys. I can't do it for you. You got to do this on your own. My information my goal is just to share the knowledge that has helped me put great trades times and times and times over again. Your goal is to act on that information and do your homework. So considering the situation with the AVGO, we still think there is a trade. And what's happening this morning is they actually, despite of the drop, you have a lot of analysts coming out and say, hey, we're actually putting a slap in a buy rating on this thing again. And they're like, they're not even slashing target prices. They're like, oh, $310 target price. So they're not even really using this as a way to get out of this trade. They're using this as a way to say, hold on, we're going to come in and buy the dip. So let them buy the damn dip. That's fine. So if the stock bounces, let's say, to 262 area, I'm very much be looking to buy some more puts. Clearly, when the stock opens, this was the entry yesterday that I sent out. It's between 280, 284 levels. So we're going to cash out. Not sure whether it's going to open, maybe 253, 255, 254, right around here. And after we cash out, we're going to wait for a bounce, and we're going to try to get back in on the bounce. Now, we don't know what the size of the bounce could be. I mean, it could just jump back to 258. But we see like a strong bounce that happens over just a few minutes to this level of 262, 264. That would be a good level to come in and short the bounce, because the probability is, look where the hugest volume actually has taken place, right? It was just immediately, look at this volume bar. Damn, this is huge. So right here, it's going to have very hard time moving above 266. So anything up to 266, I'm interested in buying puts. Okay, the question is, will we even get the bounce? Because so far, there's like just no signs of the bounce. Everybody wants to get rid of it. So I'm not sure if these analyst rating and them not being actually bearish on this thing, despite of CEO saying, hey, we're highly concerned with the China situation in the United States, and it's not looking good, and things are looking rather gloomy. It's just like these analysts don't even want to listen. So I'll take the CEO's word over it, and maybe these analysts just maintaining the target prices for the stock at a higher level so they would actually have a chance to get rid of their positions because they got caught up in this mess at a higher price. So that could be an explanation. So moving forward, guys, market moves for June 13th. Move 7, and you probably wonder why move 7 definitely looked like a 5, so we're logging this as a move 7 with the behavior of a move 5. Here's a quick explanation, but before that, right, we're noticing with his move 7/5 behavior, modest switching behavior from pop and drop to buying the dip intraday. Now, this could actually indicate that market is very hopeful of a breakout above the higher trading range of the tunnel, which for us, it would be 29.05, 29.11, right? So we will be watching for any confirmation of such behavior today. And here's the detailed explanation. So here's the move 7, right? Basically, move 7, the main characteristic of a move 7 is buying the dip. So we open higher, we gap up higher, so we open higher clearly. Market starts to come in and sell off. They buy the dip. It bounces again. Here's a second time it drops, and they're buying the dip. And what makes it a clear 7 is the fact that very end, instead of making this move 6, because it really we're going for a really nice setup where the market was just going to continue to drop, but then we got strong bounce out of nowhere. And when you get strong bounces like that at the end of the day, on days where it's just, you know, the headlines are very negative, that really tells you that, hold on, the market really wants to move high. But the question is, will it actually be able to break out of these level of, 29.05, 29.11. So that's what we're going to be watching today. But clearly, watch the formation, right? It's a double bottom. It's a W intraday. If we combine a little bit of the action here, really we're moving higher, opening higher, making a dip, they're buying the dip again, and finishing at the highest levels of the day. So this is a green move. This is a 7. But if we were to just draw a line right here, this red line, I mean, really, the market's just not going anywhere, right? We're plus, minus 10 points. However, notably, the markets did end up finishing plus 14 points for the day. Typically, in a move 5, your intraday moves are going to be a little bit smaller, maybe plus, minus 5 points, plus, minus 7, 8 points, plus, minus 10 points. When you're getting above 10 points of the move and the way the market finishes for the day, predominantly, it's going to communicate to you that it's not a 5, it's a move 7 in this particular case. That's why we're logging it as a 7, because overall the market's gained 14 points for the day. How does this compare with the action we've been noticing? So we've just said, okay, so pop and drop has been the predominant pattern. Pop and drop. Now that looks like it's switching yesterday, but rather modestly, right? So instead of pop and drop, now we're getting this situation where the markets are doing this, pop and drop, but buying this level. The market just does not want to surrender this level, so it looks like it's more of a buying the dip type behavior. So let's see if we're going to get further developments on that today, further confirmation of that, because that would be super, super crucial to what actually happens next. So today's sequence is going to be 11-7. This is your move 11. This is your move 7. 11-7 is a very nice combination. Oftentimes, it ends up in 11-7-1 followed by a 3, 11-7-2 followed by a 3, 11-7-4 followed by a 3. So Monday could very much be a 3, which logically makes sense. I mean, there could be, who knows? We may get a war with Iran over the weekend. I mean, I hope not, but, anything is possible when we're heading into the weekend. Anything can happen in Hong Kong. There's just too much stuff going on out there that could take place over the weekend. And so that's when the probability of market gapping lower on Monday is actually increasing. Now, oftentimes in a sequence like 11-7, we may not get that extra day in between a bigger drop. So we may just cut out all these 1, 2, or 4 move today, and we may just head straight into a 3. So it could be 11.73. So the markets are slightly down so far pre-market. They're showing signs of resilience. I mean, as a matter of fact, Amazon was down already 10 bucks at like 5, 6 in the morning on light volume, and then now it's bouncing above that, 20. And now it's bouncing above that 1860 level again. So it was down as low as 1850 pre-market. So markets were opening rather negatively, but again, they're showing this type of behavior. So we could be easily just staying in that tunnel, in that trading range. And again, if we're noticing this behavior resume, that's wonderful. We're heading for a solid drop. But if we're seeing that buying the dip behavior resurface again today, that tells us the market really wants to move higher from these levels. So we've got to be extra cautious. Here's your 5-day sequence: 1, 11, 2, 11, 7. Logically, we could see another red move, which would be a 3. It would turn into an 11, 7, 3 type sequence, which does happen quite frequently. So here's the main thing. Okay, short-term head and shoulders could be in jeopardy, or transition to a multi-top after failure to break out yesterday, meaning break lower. So here was this head and shoulder that we've been focusing. Yesterday it had a really good chance to actually break through this level, and instead we got a move higher. So generally that tells us that there could be another run at this level of 29.11, and depending on what happens, that we could break out higher. So got to be extra cautious right here, because maybe what we were looking at on a shorter time frame, on like a 5-day chart, what was appearing to be a head and shoulder could now be just one shoulder. We could actually form a head right around the Federal Reserve announcement, followed by a drop and the other shoulder developing there, heading into a much bigger drop. So head and shoulder formation, even though it still continues, so far pre-market, it appears to be in jeopardy. So a very bearish sequence, but VIX is the missing ingredient. That's what we're talking about that yesterday, guys. So VIX is the missing ingredient. That's kind of like the main thing for today. The main thing for today on the VIX is the fact that it's stuck around 16. And even with all the negativity about 5 a.m. so far this morning, it's just hesitant to break above this 16.53 level. And the problem with that is now it tried to get above 16.53 many times. This is actually how the chart looks pre-market on the VIX. So it tried to break out above that 16.53 level 1, 2, 3, 4, 5 times now. So you can look still at this as a probability that it could, but to me, the more times something gets to a certain level and it fails to break, the less likely it's going to break it. So the probability of this is now less. However, pre-market, we did hit a 16.4 level of the VIX, which was rather bullish for the VIX, and it does appear like there's more accumulation here. Possibly could be followed by a breakout. Certainly we got this double bottom formation. Another way to look at this is, we got solid uptrend, dot 1, dot 2, dot 3, dot 4. If you connect that, that's a solid uptrend. But the question is, if we don't break out above 16.53, I mean, clearly I may consider just not trading anything Monday, Tuesday, Wednesday morning until we get that Federal Reserve announcement, because if VIX does not break above that level today, we could just have very small moves to the upside, maybe 5, 10 points on each day consecutively. I don't want to be caught up in that environment, because ultimately it's just better to utilize the capital on the days where you're going to get a bigger move, guys. Targeting the smaller moves just doesn't work as good when you're racing against time trading these weekly options. Okay, so just keep that in mind. But with that said, if we do get the break above, here's a slide from yesterday. It's very important that we do increase our put positions, because that could signal a much bigger drop in the making much faster than what most of the market participants expect. So the market moves for today, we're projecting move 3. Clearly, we're slightly gapping down already. Once we open, we could try to close that gap and then resume the drop, move a variation of move 11. And the 7-5, kind of like yesterday, on the 13th, we got a move 7 with the behavior of the 5. That could easily just duplicate itself, not just today, but also Monday and Tuesday. So lots of possibilities here. We have too many possibilities. It's better to trade small, or don't trade at all, guys. So key takeaways. It pays to focus on certain sectors on the bounces today, particularly semiconductor sectors. Anything that, Apple suppliers, Apple itself. Trade smaller positions, ideal until June 19th, unless VIX starts moving in the right direction. Prepare for a breakout higher in the S&P futures is if VIX actually fails again. So in other words, if intraday VIX makes an effort to run against that level of 16.4, 16.5 and it fails again, then guys, that is your signal to actually cut your put positions. And at that point, the probability of VIX hitting, again, that level of 15.7, 15, possibly 14.7 becomes more probable. So, guys, with that said, try to catch the bounces in the semiconductor stocks. Short those bounces, especially target the last 2 hours, because the behavior yesterday could reverse. We've seen it many times to where we have an occasional spike higher going into the very last part of the day, but then the next day we have the exact reversal of such behavior. So I didn't put it as one of the variations, but move 6 going into the last part of the day could be very interesting. People could freak out, especially if there's any tweets coming out throughout the day, and people may freak out to keep some bigger positions going over the weekend into Monday. So with that said, guys, trade wisely today. Don't go all out. Don't put any big positions out there. And focus on buying options at a really good price in the last couple hours on the bounce in semiconductor stocks. That should create some really great trading opportunities. Guys, with that said, I wish everybody a great weekend. I'll catch you on the next trade Monday.